All right. So we start right away, ladies and gentlemen. We are doing transfer pricing, the easiest topic ever. One of those topics that students fear for nothing. We shall overcome. Yeah, so there we are. So you're told question number 5, Manuko has been offered supplies of special ingredient Z at a transfer price of 15 per kilogram by 𝗕𝗢𝗄, which is part of the same group of companies. 𝗕𝗢𝗄 processes and sells special ingredient Z to customers external to the group at Kenya shillings 15 per kilogram. 𝗕𝗢𝗄 bases its transfer price on total cost plus 25% profit markup. Total cost has been estimated as 75% variable and 25% fixed. They want us to discuss the transfer price at which 𝗕𝗢𝗄 should offer to transfer special ingredient Z to Manuko in order that the group profit maximizing decisions may be taken on financial grounds in each of the following situations. A, 𝗕𝗢𝗄 has an external market for all its production of special ingredient Z at a selling price of Kenya shillings 15 per kilogram. Internal transfers to Manuko would enable Kenya shillings 1.5 per kilogram of variable packing cost to be avoided. So we start with scenario A. So scenario A, what do we have? We have an internal department called, in this case here, 𝗕𝗢𝗄, which is supposed to sell some ingredient Z to a company here known as Manuko. And we are told very, very well that 𝗕𝗢𝗄, this Z, has external customers for Z. External customers for Z. And then, of course, it is able to sell outside there this product for what? Yeah, somebody? For 15. Now, so solution part A, remember part A, they simply want us to give them an optimal selling price. Yeah, in this case here, 𝗕𝗢𝗄 sells to Manuko here. Yeah, sells to Manuko internally. So basically, they want us to give them optimal internal price. What we call the optimal transfer price. Optimal transfer price. So you see here, 𝗕𝗢𝗄 is busy. It has external customers. If it has external customers, the only way out here, optimally, to be able to give them our product Z, the units, is to ensure that we treat them as external customers. External customers. So in this case here, we are saying there that Manuko will be treated as an external customer. As an external customer, and therefore the ideal selling price of ingredient Z, yeah, is Kenya shillings 15. It's Kenya shillings 15. So the only thing, please listen, whenever you are told that this internal department has to make some internal transfers, and then you are told that currently this intermediate good has some external customers. Yeah, if I'm selling this thing at 15 bob to these external customers, then Manuko can only benefit from us, from our intermediate good, if it becomes as well, yeah, as good as what here external customers who are procuring this at 15. However, there is a rider there. There is a rider there. There is some savings, in this case here, to accrue to 𝗕𝗢𝗄. Should we decide in this case here to do what here, to sell this thing internally? Such savings shall reduce this price, because we are told, ladies and gentlemen, remember, if 𝗕𝗢𝗄, for example, is to sell internally, they will not incur any advertisement cost. No advertisement cost. So there shall be some savings to be made for transfer pricing internally here. There is some savings to be made. For instance, we are told in this question that if 𝗕𝗢𝗄 decides to sell to Manuco, which is internally here, they will not incur any packaging cost. They shall be able to save packaging cost. We are told in this case here, packaging cost, is it 5? It's 1.5. We are told somewhere here that internal transfers to Manuco would enable Kenya shillings 1.5 per kilogram of variable packaging cost to be avoided. So then that has to be passed through our sister department. Now, because of the savings, cause of savings on packaging price, then the optimal transfer price, will be 15 minus 1.5, which gives us 13 point what here, somebody? Which gives us 13.5, which gives us 13.5. Yeah, which gives us 13.5 like that. Great, thank you. Which gives us 13.5. So anytime, and I repeat because this has been very, very common in your exams, where you're asked about optimal price. If there is an external market, then the external selling price becomes the optimal price. And if there are any savings, those savings should be subtracted. There is another method which you guys must also be aware of. This other method goes like this. Method number 2. Method 2. So method 2, the optimal transfer price, will always be equal to marginal cost plus any opportunity cost. So this is a very, very good method number 2, that to get optimal transfer price, you will take the marginal cost. Marginal cost is the same as variable cost. Marginal cost is the same as variable cost. So you take marginal cost plus any opportunity cost. Opportunity cost is a lost contribution margin. Opportunity cost is the lost contribution margin for not selling goods outside there. For not selling goods externally. Yeah, lost contribution margin for not selling goods externally. Let me ask you a question, ladies and gentlemen. Is there somebody who is able to remember the formula of getting contribution margin? You guys, you ninja. How do we get contribution margin? It is selling price minus variable cost, isn't it? You see the online guys, great, they are right. So it is selling price. Minus variable cost. Now, ladies and gentlemen, we know the price that 𝗕𝗢𝗄𝗣 is selling these goods at outside there is 15, but we don't know the variable cost. And many students would not have gotten this variable cost. And yet it is given here very clearly. It is given here very, very clearly. We are told, ladies and gentlemen, we are told here that 𝗕𝗢𝗄𝗣 bases its transfer price on total cost plus 25% profit markup. That anytime we are getting selling price, we take the cost plus 25% markup, 25% of cost. So anytime we are getting any selling price, we shall always take the cost that we incurred plus 25% markup on cost like that. The selling price here is 15. Yeah, so we have cost plus, this is 0.25 cost. So then this will be 15 equals cost plus this, it will be 1.25 cost. Meaning that cost will be 15 over 1.25 like that. So is there somebody who is able to give me the cost here? Sorry, I had 12, yes. 12. So remember, selling price is cost plus 25% of the cost. They may not be able to see my other side of the board. I have to twist this a little bit. Yes. Great. Yes. So then out of these 12, they are telling us that a certain percentage is fixed. Variable. Let me start with variable. And a certain percentage is fixed. Yeah. So then in this case here, variable is what percentage? 75%. Yeah. So variable is 75%. So then can you kindly give me 75% of these 12? So variable cost is 75% of the 12. 75% of the 12. 9, eh? So somebody is asking why 1.25 and not 0.25? You know, 0.25 is on top of 0.25 is on top of, see what I did here. Selling price is cost plus the profit. And the profit is 25%, your 0.25, 25% of cost. So when you take 0.25, you know there is an implied one here. One cost plus 0.25 cost. It gives us 1.25 cost. So then cost will be 15 over 1.25, which is 12. If Miriam, you try working with 0.25, you will get a crazy. The cost will be far higher than the price of 15. It wouldn't make sense totally. Yeah. So then we know the variable cost is 9. And because I'm doing marginal costing, I don't need fixed cost. Don't give me the fixed cost. So then come and give me this contribution margin to be lost. So in this case here, when you are selling to external customers, we fetch a price of 15 versus our variable cost. Variable cost, you guys have been able to give me 9. So 15 minus 9, that will end up giving me what here, somebody? 6. That will end up giving me 6. So for any sales that I divert, that I snatch from external customers, I shall be losing this much. So this figure then must be compensated to me by this department, which wants me to sell goods to them internally. So then let's get, ladies and gentlemen, into business here. Let's get into business here now. So then the optimal transfer price will be equal to our marginal cost of production. Remember, marginal is the same as what you have, variable. So marginal cost of production, which is the same as variable cost, you guys have given me a figure of 9, isn't it? But now remember, we are producing this internally. We are producing this for our internal market. We shall be able to save the packaging cost. We shall be able to save the packaging cost. Plus now the opportunity cost of how much here, somebody? 6. Plus opportunity cost of 6. Yeah, which will end up giving me what figure, somebody here? 13.5. So whenever there is an external market, the very best concept is for you to know that whenever there is an external market, always the transfer price will be equal to external market minus any cost savings accruing to the fact that you're producing these goods for internal consumption. Internal consumption. So I'm so sure this may not be able to make lots of sense to you at the moment, but let's continue. And then I'll be able to simplify these as we progress. So let's continue. And then I'll be able to simplify these as we progress. So we look at the second scenario. Let's look at the second scenario. So part B of this question. What do they want us to do in part B of this question? So part B of this question, ladies and gentlemen, is quite an easy one. They're telling us that conditions of A above shall prevail. But now 𝗕𝗢𝗀 has production capacity for 3,000 kilograms of special ingredient Z for which no external market is available. Yeah. So ladies and gentlemen, now there are two issues here. So we have two scenarios here. The first scenario, is where in this case here we are told that we have up to how many? Is it 3,000? 3,000 idle capacity or 2,000? That we have got in this case here for condition 2. So for condition 2, what are we told, ladies and gentlemen? That, has production capacity for 3,000 of this Z, for which there is no external market. If there is no external market, it means that we are idle. Yeah, and then of course, in excess of, and then in this case here, so it means, ladies and gentlemen, here, that the transfer price, so transfer price up to 3,000 units. When we are idle, this basically will be equal to marginal cost. Marginal cost. You can even just write marginal cost plus our opportunity lost. Opportunity cost, like that. So the marginal cost, remember you gave me a figure of 9 minus 1.5. But now remember, these 3,000, if I'm going to produce up to 3,000 units when I'm idle, there won't be any opportunity cost. There won't be any opportunity cost, because opportunity cost arises whenever I'm snatching goods from some external buyers to sell internally. But you see, up to 3,000 units, we are idle. There is no external market there. Up to 3,000. But in this case here, then, should we decide to go beyond? So in this case here, beyond 3,000 units. Now remember here, we have external customers then. We have external customers. We have external customers. Don't forget that. Remember, it is only up to 2,000 that you don't have customers. All right. Then the transfer price here, in this case here, the transfer price will be the marginal cost. 9 minus 1.5 because you are transferring these things internally. But now remember, we shall be able to snatch goods from external customers to sell internally. Yeah, so then we shall lose how much? Do you remember the 6 we are losing? They have forgotten the 6. They have forgotten the 6. Because for every customer, external customer we sell to, we are getting 15. Minus, in this case here, our 9. So that takes us to what here, somebody? 6. That takes us to 6. That takes us to 6. There is a student who has come in a little bit late there. E6 imetoka wapi, we shall overcome. Just give us a few minutes. Give us a few minutes. So then this takes us back to 13 point what here, somebody? And this is 7.5. 7.5 and 13.5. Yeah, so remember, this student who is asking, remember in this case here, we are told that the selling price is 15, if you read that question very well. And to get this selling price of 15, we have cost plus profit margin, which is 25% of the cost. So this is one cost plus, so it will be 15 equals 1.25 cost. Therefore, cost was 15 over 1.25, which gave us 12. And this 12, we are told in this case here, variable cost is 75% on that question. 75% gave us 9. And then we went ahead and looked at lost contribution margin, which is price minus variable. The price here is 12. 12, not 12, 15. Minus the variable cost. Variable cost. Are we done it well? Yeah, variable cost, which is 9. That's how we got 6 like that. So that is how we were able to get that 6. But I'm so sure should you get time to watch this video later, you will be able to understand this much better. So what have we learned about this transfer pricing? What we learned about this transfer pricing this morning is that if I'm told that some goods, we happen to be having external market for them, whatever price you're charging these external customers is the same price you shall adopt and use in this case here for any internal transfers. Less what here? Less any savings. If we are idle, then we shall only charge our internal customer the marginal cost alone. Marginal cost alone, of course, minus any savings. Let's try part C. Let's try part C. So part C, we are told conditions are as per above, but HELPCO has an alternative use for some of its spare production capacity. This alternative uses an equivalent of 2,000 kilograms of special Z and would earn a contribution of 6,000. So what will be the transfer price here? Just try it. Whatever you write will be correct. Trust you me. Whatever you write will be very, very correct. Whatever you write will be very correct. That this Z, we have got some 2,000 units of Z, which we happen to be having an alternative use. And this alternative use will be able to give us 6,000. So our sister department, should it want us then to stop making use of this Z for this alternative use, they must be willing to compensate us. They must be willing to give us the profit that we would have earned. So the very first thing that I would have done is to get profit per unit. Because 6,000 is for how many units here, somebody? 2,000. So what is the profit per unit there to be earned? Is it 3? Wait, the online ninjas. So you can see in this particular case, the alternative use for 2,000 kilogram earning 6,000 contribution. So you're able to see the contribution or the profit per kilogram, which will be 3. Then the transfer price optimal will be what here, somebody? Remember the formula. The formula, this is really, really easy. This is really, really easy. The very best thing, if you don't ever want to get this wrong, always remember that our optimal transfer price equals who? Equals a marginal cost plus what here, somebody? Any opportunity cost or opportunity to be lost. So if in this case here, they want us to change. Yeah, remember we have an alternative use for Z. Yeah, remember the marginal cost still remain at 9. Variable cost was 9, isn't it? But don't forget that still we are going to save on the packaging, isn't it? And the opportunity cost in this case here, remember we are going to earn a profit of 6,000. But from how many kilograms here, somebody? 2,000. Remember, this is cost per kilogram, cost per unit. Cost per unit. So it means that this, I'm going to lose this opportunity. Yeah, if my sister department wants me to sell these units to them, I'm going to lose this opportunity. So he must be willing to compensate me. So then that will end up giving me what figure, somebody here? 10.5. 10.5. 10.5. Like that. 10.5. They must be willing to give me that 10.5. They must be willing to give me that 10.5. Now, before I go to a very good past paper question, ladies and gentlemen, allow us in this case here to go to this other shorter question, ACCA question, which in this case here your examiners will always borrow quite a lot. Question number 6, X, a manufacturing company. X, a manufacturing company, has 2 divisions, Division A and Division B. Division A produces one type of product called product X, which it transfers to Division B and also sells externally. Division B has been approached by another company which has offered to supply 2,500 units of product X for 35. The following Details for division A are available. We can see sales to division B. We can see external sales. We can see variable cost there. Yeah, we can see fixed cost, and they're able to get a profit of 218,000. External sales of product X cannot be increased, and division B decides to buy from the other company. So required, calculate the effect on the profit of division A. This is a very, very easy question. So what I will always do is to capture this information in form of what here? A diagram. Capture this information in form of a diagram. So we have here division A. Yeah. Then we have in this case here division B. Yeah. So division A is able to sell externally and internally. So division A is able to sell externally, and internally. Please always ensure that your diagram is quite big. Your diagram should be quite big to accommodate a lot of information. And this is a straightforward question. So what have they told us here? So they have told us here, ladies and gentlemen, here, sales revenue. You can see sales revenue to be at 40, be at 40. So basically, they are giving us the transfer price. Yeah, they're giving us here division A to B. Transfer price is 40. Transfer price is 40. Yeah, external price is 45. Very good business. Externally, we sell 45. Internally, we are selling 40. Good business. And then there is another ninja who has seen an opportunity, who is making this product X. Yeah, who has seen an opportunity that he wants to transfer to us this product X at a lower price. You can see a division B has been approached by another company which has offered to supply 2,500 units of product X for 35 each. Yeah. So in this case here, we have, ladies and gentlemen, external seller has approached B to sell 2,500 units at 35. So if you are the manager at division B, what do you think will be the best decision for you? Buy from A simply because A is your sister department, or do you buy this from this external manager, external market? Yeah, buy at 35. I also agree about that. I agree with that. I will buy in this case here at what here? At 35. So then what will be the impact if we buy? So in this case here, we will buy. So B, decision at B. Decision at B. Yeah, buy at what here? Somebody at 35. Yeah, what will be the impact on A's profits? That's what they are asking you. Save cost, I like that. So what will be the impact? I'm waiting to hear from you. Do some calculations. Give me. You guys are management, not actually management, senior management accountants. Senior. Do some calculation there. Give me an answer. By how much do you expect the profits of B? Let me give you a second, ladies and gentlemen. You always calculate the lost CM, the lost contribution margin. So impact on A's profit, give me the lost CM, the lost contribution margin, the lost CM. And of course, you guys are pretty much aware that CM is price minus variable cost. So you can see, ladies and gentlemen, if, for example, A was to sell internally, then they would have earned a price of 40. And what is the variable cost for division A per unit? Is there somebody who is able to see the variable cost 22? I'm being told 22 like that. So remember, A is going to buy 2,500 units from an external market. So we will lose that opportunity. This will be contribution per unit. So I want total contribution to be lost from this opportunity of selling 2,500 that I've lost. What, 5,000? 45,000. So, and that is it. So this 45,000, ladies and gentlemen, is what we shall lose as A. If we sold the 2,500 units here to B, the selling price would have been 45, the variable cost would have been 22. I would have gotten some great contribution margin there times the number of units that now we are not able to sell. And then remember, this examiner is very, very categorical that there is no way A will be able to push these units here to external market. The external market is already saturated. That's what we are told. The external market is already saturated. So we shall lose. Somebody is saying no impact. There shall be an impact. There shall be an impact. There shall be an impact. So in this case here, division A's profit is decreased by this 45,000. Thank you so much. How about part 2 of this question? Part 2 of this question, ladies and gentlemen, calculate the effect on the profit of the whole company now, company X. Calculate the effect on the whole, or the profit of the whole company. I'm giving you 5 minutes. Try that, we see. Just think, 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 think. Think, 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 talk to me. Just try, so even if you don't get it, so what? So long as you've tried. That is the most important thing. Remember, whenever you're looking at this at the group level, whenever you're looking at this from the company's level, transfer price becomes what? Irrelevant, totally irrelevant. So don't use transfer prices anywhere. You simply ask yourself very simple questions there. Very simple questions there. So can I do it? Can I do this question? So transfer price cannot be used anywhere in your calculation. Transfer price cannot be used anywhere in your calculation. $57,500. Most of them are saying, well, let me do it. Yeah. So this is basically pure comparisons. Pure comparisons. Basically pure comparisons. So in that case here, the whole company is faced with the two alternatives. So the whole company has got a whole company has two alternatives. Yeah, produce Z internally and incur a relevant cost of 22. The variable cost, because you see fixed cost here is irrelevant, because whether you're producing internally or not, fixed cost like rent has to be paid. Or in this case here, you outsource, procure, or outsource, yeah, externally. At how much? At 5. So the loss on outsourcing is visible. It will be 35 minus 22 times 2,500. The loss on outsourcing is very, very visible because you can see it's a higher cost. It's a higher cost. So how much are we able to get there? And is there anybody who thought something like that? Anybody who got it right? 32,500? Oh, that must be a serious ninja. That must be a serious ninja. Yeah. So at group level, internal transfers are irrelevant. What matters is the economic cost. Buying externally cost of 35 instead of internal variable cost of 22. Yeah, so the extra cost that you're going to lose there is 13. So 13 times that gives us 32,500. Now, as you open your past papers, because now that would mean that you have finished model paper 1, as we go to our past papers, I think it will be wise for me to just take 10 minutes of your time to show these online students how question number 4 is done, and then we can now bury this paper. Eh? But it's a very easy question, really. This question number 4 is very, very easy. I'm so sure you guys will be able to gain something as I repeat doing the question. Eh? And it's only 10 minutes. I'm not going to do it fully. It's only 10 minutes. So question number 4. KM is considering a new project and has gathered the following data. The initial investment is Kenya shilling 66, which will be required at the beginning of the year. The project has 3-year life with a nil residual value. Yeah, depreciation is calculated on a straight line basis. So let's first of all calculate that depreciation. So straight line basis, right? And no scrap value. So basically it will be 66 divided by 3, which gives us 22. And then now you can even go ahead and give us the written down values for each of those 3 years. Written down values at the beginning. So at the beginning, year 1, 66. The whole year it loses 22. So they come to year 2, then we are beginning at 40 what? The whole of year 2, it loses 22. Then the beginning of this will be 20 what? Here somebody will be 22. Yeah, thank you so much. I can see Rina already did this. Is there anybody who was able to do this question number 4, the online ninjas, by themselves and they think they're right? Anybody who was able to do this and they think they got it right? They haven't gotten time yet. We shall overcome. We shall overcome. Great. Great. Yeah. Then let's look at the best outcome. Best outcomes. All right. So we are told here that the project is expected to generate revenues of 85, 90, and 94. 85, 90, and 94. Yeah, so we have 85, 90, and 94 in year 3. These values may vary by 6%. May vary by 6%. So varying means what year could either increase by 6% or reduce by 6% either way. So we want to do best outcomes. So best outcome for revenue, what does it mean regarding that 6%? It increases. So the very best outcome, the best scenario is us to grow the revenue. So best revenue will be this times 1.06. Yeah. Because best, we are varying it and increasing the revenue by 6%. We are increasing the revenue by 6%. So then what is the best revenue? Yeah, how we distribution of depreciation. You see depreciation, we have here year 1, year 2, year 3, yeah? Yeah, so this was 66. Yeah, when we come to year 2, we talk of 66 minus what we lost in year 1, because 22 is every year. So this will give us 44. Then here this will be 44 minus what we lost there. 22 like that. All right. So the first one I'm being given 90.1. The second one 90.5, 95.4. So big, okay. 99.6. Give us the costs. Yeah. 99.64. Or just 0.6 like that. 24. Whichever, isn't it? 24 sour, whichever. 24. So what have they told us about cost? So the cost that they have told us, ladies and gentlemen, is that this cost here, the direct cost will be 50, 60, and 70, isn't it? 50, 60, and 70. And this could vary by what here, somebody? By 8%. So that then what is the best cost? You know, varying means either increasing or reducing. So the online ninjas, one is wrong, Okay. Yeah, okay. The online ninjas, what will I do to get this best cost? Online ninjas. Because you see, first part is best outcomes, best revenue, best cost. Yeah, reduction by 8%, yes, reduction by 8%. And a ninja has been able to tell me that Mwalimu multiply by 0.92 throughout. Because 100% minus 8% is 92%. It's 92%. Why by 10, Christine? It's 8%. It can vary by 8%. It can vary by 8%. So the best cost will be lower by 8%. Then give me these figures, you ninjas. Give me these figures. 46, Exactly, or point something? Exactly. The second one? 55.2. 70. What do you do? Yeah. Then give me the best profit. So best profit will be best revenue minus best cost. Give me this. So you take 90.1 minus 46, which will end up giving me what figure? 44.1, eh? 44.1. Aha. 95.4 minus 55.2. Yeah. Yes. Depreciation. Yes. I forgot this. How could I forget this? We have here profit. Profit, it will be this revenue minus cost minus depreciation. Yes. Thank you for that. Minus depreciation. Because the only expense you're not subtracting here is tax. So basically, you're going to get PBT. Yeah. So take revenue minus cost minus depreciation. So then this one here will be 90.1 minus 46 minus what here? 22. Sorry for that. Yeah, sorry for that. So the first one gives us 22 point what here? 0.1. The second one will be 95.4 minus 55.2 minus 22. 18.2, eh? So this gives us 18.2. Then here we have 99.64 minus 64.4 minus 22, which will give us what figure? 14 point? 13 point what? Exactly. 0.04. 0.24 like that. Yeah. Had we been given a rate of tax, if I were the one setting the question, I would have provided tax at 30%, then we would have gotten a PAT. All right. So then there we are doing very, very well. So now you can go ahead and give us residual income, return on investment, etc., like that. So we have done the first one, which is what here? Which is the first one, which happens to be the best outcome table. So then you ninjas, are you able to give me the worst outcome table? These ninjas, are they able to give me the worst outcome table? Worst outcome table. Wanaweza ama hawawezani? So hapa worst revenue itakuwa now the normal revenue but less 6%. Normal revenue less 6%. First cost will be a higher cost. I think with that guidance, I would expect you guys to give me better now tables. Yeah, later on now you guys can work on better tables. Mine was to guide you. Otherwise, the students that are seated here and they are done that whole question, it will be disastrous to them. You guys wanted some guidance. After all, your class you guys will be doing this question. Yeah. In your class, will be doing this question in full. All right. So then if that is okay, we can go back to the transfer price. Of which I want us to straight away go to August 2024, question number 1C. August 2024, question number 1, cow. August 2024, question number 1, cow. Once you get that question, please say, oh yeah, we continue. August. Have they gotten the question? August 2024 question number 1, Carl? All right. So Optima Gas Limited has 2 divisions, Beta Division and Optima Division, which operates as profit centers. Beta Division makes a component known as token meter, which is a prepaid pay as you use token device used by Optima Division to make Optima gas cylinder. To optimize digital payment, prior to Beta Division being established, Optima Division outsourced the component on the external market at a price of 1,600 per token meter. Beta Division has an external market for the token meter and also transfers to Optima Division. Optima Division uses 1 token meter to produce a gas cylinder, which is sold externally. There are no other products produced and sold by these divisions. They forecast annual sales, associated costs, and the capacity level for the divisions are as follows. They've given us so many things there. Additional information. The variable cost for a gas cylinder excludes the cost of the token meter. The first unit of a token meter will take 20 labor hours to produce. However, it is known that the work for direct labor is subject to an 85% learning curve. Good examiner. Mixing learning curves with transfer pricing. He wants to kill these students. This will apply to all the 260,000 token meter production capacity. The Optima division will continue to outsource 40,000 token meters from an external supplier at a price of 1,600 to eliminate the deficiency from internal transfer. Optima division has a target profit of 180 million. The forecast external sales and the production capacity level for the divisions are as follows. So you can see Beta Division external sales, 100,000 token meters, Optima, 200,000 cylinders. Production capacity, you can see there, Beta has 260,000 token meters, 300,000 cylinders. Required, they want us to give them the learning curve coefficient. Learning curve coefficient. Do they still remember the learning curve equation? So learning curve, they want us to just give them the value of B. That's very easy, but you can just go ahead and do the whole of it, the prediction. So we know that our learning curve is Y equals A X B plus 1. A is the time or labor cost per unit for producing the first unit. Yeah. All right. Which in this case, they've given us as what here, somebody? 20. R, they've told us R is 85%. The learning rate. Learning rate is 85%. And we know the formula for getting B. Are you able to remember the formula for getting B? B equals who? Log R over log 2, isn't it? Log R. Remember it's question 2, see, eh? Yeah, it is log R over log 2, which will be log over log 2. You see now, even if I never knew anything to do with transfer pricing, your examiner is very lenient. He simply wants you to get some marks. So negative 0.234 something. We like 4 decimal places, 5. We like 4 decimal places. And therefore B plus 1. Is it 4, 3, 4? So it will be 0. Which will end up giving us what figure? Thank you. And therefore, y equals a x raised to 0.7655, like that. Yeah. So now that we have done very, very well. They only wanted the learning index, which is B, but as we are we have gone even ahead to give them what they never asked us to do. No, B alone. Before, yeah, B alone. Learning curve index, learning curve coefficient. That is what here, B. Thanks for asking. In columnar format, prepare the profit statement showing the operating and operating net profit for beta division and Optima division, and indicate whether Optima division targeted profit will be achieved. Very, very easy. But first, we must understand our diagram. Yeah, we must understand our diagram. So we have two divisions. So we have Optima and beta. So we start with beta. Beta is the one making the intermediate good. So we start with beta here. Very easy. Come to the capacities. So you can see beta has external sales of 100,000. 100,000. And then Optima has 200,000 cylinders external. Very good. Very good. Very good. And then the production capacity, we can see for beta, 260,000, beta, 260,000, 260,000, 260,000. Yeah, total capacity. Meaning that it can very comfortably, without snatching anyone's business, it can very comfortably transfer how many internally? 160. It can very comfortably transfer 160,000 without snatching anybody, any business. And if it doesn't transfer, if it doesn't snatch business from anybody, it means that Optima has to buy some goods from outside. Because you see, Optima wants to sell how many? 200. And you know it's one-on-one component. And you can see they're receiving 160. So they'll have to buy 40 from outside. So first of all, draw that. Try to understand this. Oh, Julius is not able to be a mwalimu. Or is it everybody? I can just shout. So first, have you finished drawing this? Have you finished drawing this? Okay, great. So first finish drawing this and then you tell me yes. Okay, great. Great. Thank you so much. So then once you have understood this, ladies and gentlemen, doing an income statement for you as an accountant is a straightforward thing, very straightforward thing. Once I've understood this, that is it. So now let me get the parameters. So you can see here, market price per token. Yeah, beta division 1500 external. Market price external. Transfer price, in this case here, how much? 900. Market price per gas cylinder for Optima, 65. Variable cost per gas cylinder is given there. You can see direct labor cost, yeah. You can see direct material cost per token, yeah. Variable overhead per labor, yeah. Fixed cost per annum is also given there. We can now read this slowly. We are told number one, the variable cost for gas cylinder excludes the cost of the token meter. The first unit of a token meter will take this already. We have made use of it. Number two, already have made use of it. Three, Optima Division will continue to outsource 40,000 tokens meters from an external supplier at a price of 1,600. And I told you I was able to see this. How did I get to see this, ladies and gentlemen? It's because I can see here that this token, they are going to get 160,000 internally. So it means that they have to outsource 40. At 1,600. Optima Division will continue to outsource 40,000 token meters from external supplier at that price to eliminate the deficiency from external transfer. Yeah, the others are neither here nor there. So let's try posting this into the P&L. So beta, external sales is how much? How much are we selling to external market? Please talk to me. 1,500, eh? 1,500. And then internally, how much are we getting? 900, isn't it? Yeah. So here, the most important thing that I'm so sure not many students will be able to know is how to get the labor cost. Labor cost for A, labor cost for beta. So labor cost for beta. So labor cost for beta, fortunately, they have told us we're using learning curve, right? Learning curve. And we know y equals 20 x raised to 0.76. Was it 55? Yeah. So then how many units shall we be producing? How many units shall we as beta be producing? 260,000 total, isn't it? 260,000. So give me y for 260,000. Because you see, in total, whether you're transferring outside there or internally, in total, we have to make 260,000 units. Yeah. 279 something? 878. 378. And remember, these are hours. 270, 279, 378. Thank you so much. Remember, those are hours. So give me profit statement there. Yes. 279? Sorry for that. 279, 378 hours. Thank you. 377 point. I don't round off too much. I'm only rounding off here because I'm a lazy teacher. Anyway, because you're learning here, isn't it? In the exam, you shall write, in this case here, decimals. You should write decimals. You should write decimals. Because mine, I'm only doing it for demonstration. Just driving the concept home. They have told us to do this in columnar format. So we have beta, we have optica. The spaces must be very big, Yeah. So profit statement, so we start with sales. So external sales. So for beta, you gave me what to sell externally. You told me externally I should sell how many cylinders? 100,000 at 1,500. $150 million, the amount of money that I'm looking for. 150 million. Internal sales. It is 160,000 times. Wanafunzi wa online waniongeleshi. Wanafunzi wa online sasa waniongeleshi. Yeah. Because I'm using that diagram. Remember, I already have the diagram. 144 million, isn't it? 144 million. And then when you're working for beta, please finish beta totally. Don't do like side by side. No, do everything for beta until you finish. So we go to costs. So costs. Try to follow the format they have given you. We start with which one? Yeah. Try to follow the format they have given you. The first one up there you can see is variable cost per cylinder. That variable cost, is it applicable to beta? Really? No. Because now we are working for beta. Optica. The very first expenditure applicable to beta is which one? Direct labor cost, isn't it? Yeah. So give me labor cost. And labor cost, of course, you shall take something times something. Labor cost, I shall take something times something. So I'll take 150 per labor hour times who? Number of hours. You guys gave me hours, yes? So 150 times number of hours. So according to 𝐂𝐼𝐅𝐻, it should be 41,906, 700, Next cost. Direct materials, isn't it? Direct material cost. Remember, you don't have to get like everything. You don't have to do it like me. Mwalimu is looking at it from the point of perfectionism, but you guys in an exam, when you're doing these exams, you'll be panicking. The most important thing is that you should just be able to do what here, post as many correct entries as possible here. So don't look for perfectionism in an exam. No. Thanks, Lois. So direct material cost per token meter. So then telling me I should take what times what? At least the physical students have heard you. Let me get these other ninjas. So for material cost, I should take 250 times. Then is it for why 400? Why 40,000, Rina? Remember it is materials for, yeah. Remember the 40,000 Rina will be applicable here in the optica. So it will be 250 times all that we shall be producing ourselves as beta, and we're going to produce 260,000. We're going to produce 260,000, which Wanjiko is writing confidently the amount 65 million. Yeah. So do we have any other item? Any other item? Before fixed cost, we don't have any other item in between. We have variable overheads in between there. You can see variable overheads and they're fixing them. Let me see. These variable overheads, I should take what times what? Variable overheads, I should take what times what? 100 times? Is it 100 times 260,000? They will not be compatible. Remember that variable overhead is being fixated on number of hours. Thank you so much here. Number of hours. So it will be 100 times 2, 79,378, which gives us how much? 727 million 800, like that. And then now we can talk about your fixed cost. Now you can talk about your fixed cost, which doesn't need you to think at all. Don't think at all there. Don't think at all. Beta, fixed cost for beta, how much? 15 million, eh? 15 million. $150, eh? Quite a lot of money. Like that, yeah. So then take this plus this, minus this, minus this, minus this, minus this. Give me the net profit here, or the net loss. Why do we not use? Because as we're not selling gas cylinders here, in beta, you see, you can even see that variable cost per gas cylinder. It's under which column? Are you seeing the 2500 is under optica? Can we show him the 2500, the variable cost per gas cylinder? That's a cost under optica. $21 million? 91.25. Have you seen that, my brother? 91? 55. 500. It has so many fives, eh? It has so many fives. Very good. Very good. Very good. So then I will want you to do now the P and the L for optica. For optica. Na utang'ang'ana nayo peke yako until you get it. It's very easy because already you have the numbers. You know the sales revenue. Already you have the numbers. Yeah, ng'ang'ana hata ukikosea, so what? So long as you attempt. Kama uta attempt, hawa wanafunzi kwanza wa online. Kama uta attempt, nitakupatia punishment. Nitakupatia punishment. Online student. Ndako wa attempt na utume kwa group. Now make comment kama itafika 180 million, the targeted profit there. You already have everything. 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 And this one, Optica does not even use learning curves. Nothing. The only point I know so many guys will forget is the cost of the 40,000 that was externally bought. That one, all of them forget, and it is the easiest. So, ladies and gentlemen, I'm running away to Isinya, Kajiado County. So see you in our tomorrow's what time class? Is it 12? See you tomorrow. Bye. All right. I hope you have gained something. Yeah. Great. Yes, Beatrice, I'll upload. Yeah, sure.